Yeah, so we got this. We've got a question or various degrees of this question. It's really what is management guidance? How are you meant to interpret it? And really, what is the information they provide and how you're meant to deal with it? In that sort of sense, we've had a few over the last couple of months. So, simply put, management guidance is what just management expects to occur financially or operationally in a future period, whether it be the next quarter, the next year. Depending on the company, it may be referred to Outlook or similar terms to that, but I'll just be using the term guidance to keep it a bit more simple. It is a non-standardized thing and can vary greatly depending on the company, the industry. Some industries, they'll use similar guidance figures, but then other times they won't be even remotely close to each other. The more common common guidance figures that will be used are things like revenue, gross profit, EBITDA, but even those can vary between companies since they might use adjusted figures or not standardized. They might take in things, they might have had an acquisition which they want to adjust for. So things like that you need to be considering. You always want to look at the footnotes when you are looking at guidance, as well as some other common metrics are various margins, so EBITDA margin, gross profit margin, and so on, as well as their operational metrics, such as for an oil and gas company, the amount of oil produced. They'll do probably barrels of oils per day or barrels of oil equivalent per day, things like that. As well, management may provide what I would call supporting metrics, such as the price of oil, which they expect, but they can't really dictate these metrics, which allows you to account for market expectations. So if your expectation for oil prices is lower or higher than management, you can adjust their figures and then go from there. Also, management is likely to provide guidance as a range, as even with higher company knowledge, it is practically impossible, if not impossible, to predict a financial metric down to a pinpoint ahead of the finalized results. As well, you may hear the terms miss or beat guidance. These terms really just mean a miss is below the guided expected range or above the guided expected range. And that's really that term you'll see again and again. And that may be applied to as well at analyst consensus. But then if you see miss the guidance range, normally that would be referring to the management's guidance itself. So looking at an example for Meta, or Facebook is what most people will still be calling it, since they rebranded a couple years ago now, in their Q2 press release, they have the CFO Outlook commentary or guidance. They expect revenue of 38.5 to 41 billion, so a low and a high range. There we are. So we or other management say that they would be on the low end of this range, for example, would be closer to 38.5 billion, or if on the high end, if we were saying they're on the high end of guidance, they'd be closer to that 41 billion. And you would commonly see that we expect to be on the high or low end of guidance range. And especially when management's looking a year ahead, they'll start to give commentary where they expect to be in their range, or they'll narrow or expand the range if needed. As well, they note a 2% foreign exchange headwind due to exchange rate changes. In other words, something that will impact their revenue, but they really have no control over. So for an exchange rate drastically changed, you would expect revenue guidance to change as well. And you can adjust your own figures for that. While for Meta, this will likely only shift financials slightly as they're dealing in more mature currencies. Companies which have more volatile currency exposure could have significant changes, and that can dramatically change, especially when you're looking at developing countries. If they're operationally dealing with a very developing country's currency, it can be 20, 30% over the course of a year, and it's very hard to pinpoint those currencies. So you want to take in consideration management's assumptions of foreign currencies as well as other things. With guidance as well, companies may provide qualitative commentary, which we can see here with the statement, we expect infrastructure costs to be a significant driver of expenses over the next year. The color management provides can be just as important, if not even more important than the number, as it starts to feed in what expectations they have and how you can build your own assumptions and your own models on top of that. And it will provide additional details and as well as context for what guidance, even in this case, because they say that they are not providing quantitative or numbers, you can start to build in what they're expecting even further ahead in time when you're looking at the qualitative. So don't just look at the numbers. So shifting to another company in a completely different industry, ConocoPhillips, which is an oil and gas company, they provide their production expectations, their depreciation and amortizations, their corporate net segment loss, adjusted operating costs, and capital expenditures. These are all cost figures, except for with the exception of the production figures, as they have more control over those than, let's say, even their revenue due to oil prices. They provide other metrics such as return on capital, the expected tax rate. As well, they do provide a sensitivity analysis to oil prices, and that's how you would really build out what you want their net income, assuming your assumptions. And once you fill that in, it gets a bit more complicated. Once you're at that point, you need to do a full model, but that's what you would have to do in an oil and gas company, because that is, you need to deal with the sensitivities to oil, or this is true for any other commodity-driven company, so gold, copper, anything like that. So, but as you can see, metrics will used and that they'll guide on will vary significantly depending on the nature of the business and even what the management wants to disclose. And some companies may present the data to include actual results or expected results as well, and they build out throughout the quarters. You can see in ConocoPhillips. Here they give the Q1 actuals, the Q2 actuals, as this is the Q2 guidance, and then their full year guidance. And some will break it out a bit more. And normally you'll see that denoted by A and E in their guidance. So A means actual, E means expectations. So if you do see that, just know the difference between the two. Expectations is what they expect to come. Actual is what's already occurred. Because we'll occasionally have people say, oh, they did this when the results aren't out for 6 more months. So how would you use management guidance or outlook? You'll see analysts, whether it's us or one on Wall Street, use guidance within our models to value a company, as management has, or at least should have, a better picture of the company's performance ahead of time than we can, as they have intricate knowledge and insider information. So what we do is we can use their guidance as a baseline for a model and then build in our own assumptions and change and tweak their own assumptions. Like I was saying, if we expected oil to be higher than what they did, we can put up their revenue and so on. As well, the market is forward-looking and uses guidance for the valuation. If a company has a significant shift in guidance, whether up or down, that can have a larger impact on the market reaction or the stock price than the reported earnings, which are normally released at the same time. You'll see guidance released in a press release normally, or the presentation for a quarter. And then sometimes you'll see the headlines, the stock goes up 10, 20% because they had such great guidance, or reversely, they go down because they had such poor guidance. And for example, we've been seeing this over the past year in NVIDIA. Every analyst has been effectively laser focused on their guidance more than anything else. And that's what you'll see lead the headlines is NVIDIA has popped up way ahead because they have had such strong guidance again and again. And that's something which you will see time and time again, is the market will actually rely more on the guidance than the actual results, especially for high growth companies. Additionally, guidance can really be used to help track management performance. If there are deviations from guidance, it may be due to lack of execution or even at times knowledge of the company or industry. You'll see that occasionally where their guidance just seems like they're just rolling dice to come up with guidance, which obviously that doesn't reflect great on management. So some other considerations, guidance it's only provided, like I said, in the press release, earnings call, MD&A, presentations, or in multiple spots. Sometimes management will refer to it or they won't refer to it, and they'll just have it at the bottom of their slide deck, and it really just depends. And as well, what you need to consider is management guidance may not always be reliable. We see this time and time again in commodity-based industries where they'll guide to specific revenue, but be way off due to a shift in the underlying commodity. And even then, some management is just poor at guiding in general, normally being overly optimistic, if anything, and making guidance they generally do not provide. It's not really something you can end up relying on if they do keep getting it wrong time and time again. So if you are looking at guidance, you should look at how competent management really is. Look at their past record of guidance. Look at the prior guidance for the last few years, compare it to the actual results. Were they in the same ballpark? If they did deviate, why did they deviate? Was it just because of market conditions? Was it something that out of their control, interest rates, commodity prices, and so on? So that is something you need to do, is check their actual track record. Some companies, they will release targets as well, which are in the same vein as guidance, but they're more aspirational and generally on a longer time scale and generally less specific. So while targets can be used in a similar fashion to guidance, you need to really make the distinction in the weight management puts on the precision and the timeline of their targets compared to guidance. And sometimes they'll use the word target in place of guidance, but most of the time target will refer to something 3-5 years over a long period of over a long-term plan. And I really want to emphasize that management has really no obligation to continue guiding metrics and can potentially stop at any time. Normally, you'll see this after a significant miss in metric, and they no longer believe they can predict their own results with any sort of conviction. So you'll see they no longer have guidance, and normally the market will have a negative reaction to that. So that is something that can occur. As well, they can change what metrics they guide to, and they may narrow or expand or shift guided ranges as their expectations change. And like I said before, guidance is non-standardized, and lots of times they will use non-standardized or adjusted metrics because things are unique to a company, and lots of management teams, they want to make them somewhat comparable to the broad company. So if they do have an M&A, they want to adjust their figures for that, because otherwise, most time M&As, when they initially occur, they'll have hiding costs, and you don't really see the benefit of it right away. So they want to adjust those figures so it's not, oh, we did absolutely awful, when it was really they just executed an M&A and it could actually be a positive for the company. As well, I will mention a criticism of guidance is it can cause the market as well as management to hyper focus on the select results and create short-termism for the company and it's really at the detriment of long-term results. As well, I can have management sandbagging or guiding lower so they look like they beat the guidance over and over again, when in reality they expected to be beating it, which is just poor guidance at that point. It's not really guiding the market. It's just saying, oh, we want to look good. And then the second that can't happen anymore, the stock craters once they're unable to do that. So to summarize, guidance can be a great tool to help you value a company or anticipate performance, but you should still be skeptical and consider if management's assumptions are aligned with your own.
Good. That's a really good summary of guidance for sure,
great
and
job,
how you can use it, within, when you're looking at an individual stock investment. One of the things that I would key on there is definitely the track record of management in their guidance, and how well you can take seriously essentially what their guidance is going forward. And we often will look at a management team, a company that we're either following, that we want to recommend, or a company in coverage, and you'll rate them higher if they continue to either hit or exceed guidance over time. And then the opposite is also true. If they continually, repeatedly miss guidance, I mean, that's not a company that you want to be involved with over the long term. So it's the track record of management on guidance in terms of making an investment in a company is important.
Yeah,
the successful track record.
And I would add as well is you need to be critical if they're constantly being above what they guided, because then they can be just sandbagging results. And you do see that.
You just got to definitely factor that in. Mm-hmm. Like if they're always going 10% above, they're sandbagging. The market catches on to that, right? Over time, and then you're going to, the market's going to say their guidance is at 10 cents per share. Well, you're going to get 11 or 12. So they're just going to factor that in. And if you don't hit the 11 or 12, even if you hit the 10, you're probably going to be hit. The stock gets hit. So, it's kind of, the optimal is probably they hit 10 and once in a while they hit 12, so they're on the guidance and once in a while they exceed. What you don't want is continually, underperforming the guidance. And I mean, there are reasons in a quarter. Missing guidance in a quarter is not, like, people tend to overreact sometimes. If it happens once or twice out of 8 quarters, there is one-time items that can hit a quarter and, that are unforeseen. And it is perfectly reasonable for a company at times to miss their guidance. If it becomes a pattern, then it's not a problem. It is a problem.